Hi there, Etoro. It is Monday the 7th of February, and that means it's time to take a look at what moved the markets last week. Not sure how many of you have seen these reports by Ben Laidler, Etoro's analyst. They are very, very good. I just wanted to pull out two sentences. I've highlighted them on screen. So the first one is, we are halfway through a good Q4 earnings season. 77% of S&P 500 companies have beaten forecasts with 26% earnings growth versus last year. 5 points better than expected. European earnings are even stronger. The second highlight reads, the S&P 500 January sell-off combined with continued solid earnings outlook has cut valuation and therefore market risks. The forward PE valuation is down 10% to under 20 times and 25% from its 2020 high. The volatility that we've seen through US indices in January and February of this year has been incredible. We saw a few new records set in terms of volatility, and it can be very uncomfortable. But if you look at the data, it becomes quite clear that what is happening is a reset of the markets based on a new operating context, and that prices have come down. And now we are establishing a new base for the next leg of the bull market because countries' economies are still expanding. Jumping into the indices, so the Nasdaq 100 jumped quite strongly actually from Monday through to Wednesday, well until Wednesday open. It climbed 4.5% roughly, but it dropped quite sharply on Wednesday and Thursday. And so it ended the week only slightly up. You can see this orange line, burnt orange, nearly red. This is the S&P 500, and so the price action there was similar but less dramatic. We can also see that the yields on 10-year Treasury bonds in the US have jumped through the past week or so, and they're now sitting at a multi-year high. So it doesn't necessarily move the market if yields increase, but if they increase sharply over a short period of time, then you'll usually see a sell-off in technology stocks. In terms of economic data, so we saw some interesting data out of major economies around the world. So Pmi Data is still looking quite strong. A number above 50, by the way, is quite strong. It means that that's part of a country's economy is growing. So manufacturing data out of the UK and the US is still looking quite strong. We also saw an interest rate decision out of the UK, and there were no surprises here. So the rate was increased by another 0.25%. And the EU decided to keep their rates at zero, but they're no longer saying that they're definitely going to keep the rates at zero through the rest of this year. In fact, it's looking pretty likely that they're going to hike their rates at some point this year. By far the most interesting data out of these countries last week was the non-farm payroll data, which was an enormous surprise. The number is much larger than anticipated. And this shocked the market quite a lot. The reason that this data is important is there are a few reasons. So first of all, there were the beginnings of concerns that the only way for inflation to come down was for countries and the world to basically enter a recession. I think I read the other day that the historic data says that the only time that an economy has dropped inflation from the levels that we've currently seen is through a recession. So a strong jobs report is saying that the US economy, in this case, is growing quite strongly, and there's a chance that they can slow down inflation without a recession. However, what's good for the economy in this case is not necessarily good for the market. And the reason is that if a large number of people are re-entering the workforce at the same time, there's going to be a lot of competition, there's going to be wage inflation, but also it means that the economy probably doesn't need as much support as people thought. And so the size of the surprise in this number is leading people to think that the Fed is going to be even more justified in being more hawkish. So that means that the Fed might be a lot more comfortable in raising the interest rate by more than people had previously thought. And obviously, stocks do not like interest rate hikes. A number of big companies reported earnings last week, and there were some crazy moves in share prices. So I wanted to focus on a few of those. So PayPal, going into earnings, I held 1.5% of my portfolio in PayPal stock. The stock had been beaten down through the past year or so. It was trading at 50% of its price from its all-time high last year. It's also a company with a fantastic balance sheet, and it has quite the moat in terms of its brand. However, the earnings report came out and the stock price dropped up to 28% at one point. If you read through the earnings report, I think it looks as though PayPal is having a hard time growing. even though it operates in an industry that itself is growing. PayPal's competitors are growing faster than PayPal is. But the thing that really worried me was, if you listen to the earnings call, the execs were fine during the part of the call where they present results to you because they're able to prepare themselves. But during the Q&A, it became evident, I think, that they are worried because they're pivoting to a new business strategy. They've spent some money trying things out. Now they need to try some other things out because they're not growing as fast as they thought they could. And whenever you move to a new strategy, there is a decent amount of risk involved. Now, because of these risks, I think that if PayPal is able to turn the business around, it's going to take some time. So I don't like to take a loss of, I think it was 28% on my position, but the stock prices continue to fall, and I think it might continue to fall through the rest of this year until they demonstrate that their new strategy is working. Google, on the other hand, is a company that just keeps on winning. So the earnings report was fantastic, the forecast was fantastic, and I think this 20-for-1 stock split is enough to move the stock price on its own. I don't have time to explain what stock splits are and how they work. They shouldn't move the stock price of a company, but for some reason they do. Psychologically, they affect what the market thinks about a particular stock. And so given the strength of Google historically and also in their forecasts, I've started building a position in Google. Facebook was one of those companies that set a record last week. So you can see the enormous drop here. They set the record for the largest amount of market cap lost in a single trading session. I think they lost upwards of $230 billion in market cap on the day of posting their earnings. Facebook has been a company with huge margins, posting great growth for a long time, but in their earnings report, they showed that people aren't spending as much time on their platform. Now, there are people they think that maybe Facebook wanted to show this kind of information in this earnings report so that when the antitrust lawyers start pointing at them and saying, you have a monopoly, they can say, we don't have a monopoly. Look, we've got competitors and they're stealing our customers. So the growth issue is one area that I would be worried about if I was a Facebook investor. But the other is that they are taking their profits from their business that seems to be slowing down and pouring it into a brand new strategy. Their pivot in terms of their business strategy is even larger than PayPal's. Not only are they trying to get into a new market, they're trying to create a new market. I'm a big fan of VR. I have a VR headset. I think it's incredible. I definitely think it's the future. But I also think that VR and the metaverse for the average Joe is probably 10 years away. I'm not sure how many of you know this, but Apple tried to invent the iPad before it invented the iPad. If you quickly Google for the Apple Newton, you'll see the early version of the iPad, and the world's technology wasn't at the point where they could build iPads. They had to wait another, I can't remember the time frame, let's say 10 years for technology to catch up with the dream. And I think Facebook might find itself in that same boat. They might be throwing a lot of money at something that is only going to materialize a little too late for them to make a lot of money from it. There were big implications for this big drop in Facebook's share price. People were taking it as a sign that the wider market was weak, and not just Facebook's market, not just social media, but anything adjacent to it. So payments, e-commerce, retail, etc. And so on the day, we saw a number of stocks dive. However, later on the same day, there were a number of companies that reported. So Amazon, Pinterest, Snapchat, and all of their earnings results were pretty fantastic. So it seems to be the case here that Facebook wasn't sending a sign about the wider market and just had a weak quarter. The day after Amazon reported earnings, we saw one of the biggest gains in market cap in history. Amazon's earnings report, however, had a number of pros and cons. I don't have time to run through them all today. I still think that the share price is cheap, but it might not be as cheap as I had originally anticipated. It's still my largest position, and I think it'll stay that way for a while, but my take profit point probably has dropped after that earnings report. All right, on to other topics. So the Bank of England increased their interest rate from 0.25% to 0.5%. So not a massive change, but a pretty rapid change, actually, given that they increased to 0.25% quite a short time ago. And the ECB, the European Central Bank, after initially saying that there was definitely no chance whatsoever that they were going to increase rates through this year, seem to be changing their mind. So everyone is jumping on the bandwagon. This is pretty typical, actually. Countries tend to be copycats. Once one country takes a particular action, other countries feel a bit more comfortable following suit. In terms of commodities, I'm not going to do a deep dive in commodities. So the price of natural gas has been dropping, and this is for a few reasons. One of them is that countries have started sourcing their natural gas from other locations, which has helped ease some of the price pressure. The price of oil is at a multi-year high. So I think the last time we saw the current price was in 2014. And this worries me a little bit because despite the fact that supply chains are starting to heal and interest rates are going up, the price of oil has a very strong effect on inflation. And so if it stays persistently high, then what does that mean for inflation through the next couple of quarters? Last week, most of the week was closed for Chinese businesses. The market did open on Friday, and you can see the Hong Kong 50 here. The market, the index at least, jumped quite nicely. I still feel that we have seen a bottom in this market, particularly since the country has decided to stimulate the economy in several ways. What about this week? So lots of companies reporting, but I don't think we'll see the volatility that we saw last week, but who knows really. So I don't think Alibaba is reporting tomorrow. I don't think they have posted their earnings date just yet. I'll be watching Disney and a few other companies here that are interesting to me. Zillow and Affirm being two growth companies that I have my eye on. In terms of the economic calendar, so this is going to be a far quieter week than last week. There are some interesting pieces of data, core CPI inflation coming out of the US and GDP data out of the UK, but nothing that I think could create the volatility that we saw last week. And finally, in terms of risk assets, Bitcoin and other cryptos have been on a bit of a rally. I've been a bit surprised by the strength of this rally, but I am taking it as a bit of a confirmation that we've seen the bottom for other risk asset stocks, for example, and the indices through the US. And finally, I've spoken about this, but I haven't gone into the detail. I mentioned, for example, the importance of PMI data earlier in this video. You can get the reports, the manufacturing ISM reports and the services report. They're not very long reports. I would say they're probably less than 10 pages each. And they give you insight that I don't think you can find anywhere else, definitely not in this kind of condensed form. Effectively, these reports tell you about the sentiment within the manufacturing and service industries. They give you commentary from people that are on the ground, and they provide data about trend changes in terms of growth in various important areas. Reading one of these reports is like getting access to gold dust. They're free, by the way. In some ways, this data tells you what is going to happen before it filters through the rest of the economy. As an example, if you were an investor or potential investor in Corsair, you might be interested in what computer and electronic product manufacturers are saying in terms of timelines and supply chains, because whatever's happening upstream of Corsair is going to affect Corsair further down the line. The overall message out of the most recent version of these reports is that there are troubles in supply chains, but they're easing. Demand in the US economy is still very, very strong, both in terms of manufacturing and services. All right, that's it for this week. I hope that this week is less volatile than last week was. That was absolutely crazy. And I will talk to you later.